Disclaimer: this video is for educational and informational purposes only. Nothing presented here is financial advice. Always do your own research and consult a qualified financial professional before making any investment decisions. There is a number you need to understand: $33 trillion. That is not a projection from a fringe newsletter. That is not a number invented to frighten you. It comes from Oliver Wyman, one of the most respected global management consulting firms on the planet. It is their estimate of how much wealth could be erased from global markets if the artificial intelligence boom ends the way the dot-com boom ended. $33 trillion. More than the entire annual economic output of the United States of America. You should know what that number means, not so you panic, not so you rush to sell everything, but because we are living through a financial moment that future generations will study in school. And the more clearly you see it while it is happening, the better positioned you will be to navigate what comes next. This is the story of the AI bubble that may already have started to deflate. And this is the story of why it matters to every single person on Earth, whether they own a single share of stock or not. Part 1. The concentration that should alarm you. Let us start with a number that most financial experts consider the most dangerous signal in today's market: 30%. That is the share of the S&P 500, America's benchmark stock market index, the index that tracks 500 of the largest companies in the country, controlled by just 6 companies. 6 companies out of 500: Nvidia, Microsoft, Apple, Alphabet, which is Google's parent company, Amazon, and Meta, the company formerly known as Facebook. Just these 6 companies represent 30 cents of every single dollar invested in the entire S&P 500. When you extend this to the top 7, what Wall Street calls the Magnificent Seven, their combined weight in the index reaches 35%. The same degree of concentration that existed at the peak of the dot-com bubble in the year 2000. Think about what that means for ordinary people. If you have a retirement fund, a superannuation account, a 401k, or any kind of index fund that tracks the American market, more than a third of your money is sitting in 7 technology companies, all of them deeply tied to a single theme: artificial intelligence. This is what financial professionals call the diversification illusion. You believe you own 500 companies. In any meaningful sense, you do not. You own the concentrated bet of 7, and those 7 are all betting on the same horse. Part 2. The money being spent. Here is what the world's largest technology companies committed to spending in 2026. Amazon, Google, Microsoft, and Meta, the 4 largest AI investors, announced combined capital expenditure targets of $650 billion for the year. That number has already been revised upward. Moody's, the financial ratings agency, now estimates the figure could reach $785 billion by year's end. By 2027, projections suggest it could cross $1 trillion. Let that number sit for a moment. $785 billion spent in 1 year on artificial intelligence infrastructure, data centers, computer chips, power systems, networking hardware. To put that in context, the entire GDP of the Netherlands, one of Europe's most prosperous economies, is approximately $1 trillion a year. These companies are spending nearly as much as a wealthy European nation produces in a single calendar year. And the returns, OpenAI, the company that launched this entire boom with ChatGPT in 2022, is projected to generate $12 billion in revenue in 2025. That sounds substantial, but their operating losses are estimated at $8 billion. So even while taking in $12 billion, they are losing $8 billion. By their own financial projections, those losses will double to $17 billion in 2026, then double again to $35 billion in 2027. This is not a minor detail. This is a company burning money at extraordinary speed. And it is the company that every technology investor points to as the proof that artificial intelligence is the future. The future may arrive, but the path there is costing more and paying back less than anyone projected 2 years ago. Part 3. We have been here before. In 1997, a company called Broadcast.com raised money from investors based on the idea that people would soon stream radio and television over the internet. They were right. They were completely, absolutely, prophetically right. The internet did become the dominant medium for audio and video. Streaming did replace broadcast television, but Broadcast.com went bankrupt. The idea was real. The business model, the timing, the financial structure, none of it worked. This is the central lesson of the dot-com era that most people misremember. It was not a story of foolish ideas. Most of the ideas were good. Online shopping, digital delivery, instant communication, entertainment on demand. All of it came true. The visionaries who described the internet-connected future were largely correct. What destroyed them was not the vision. It was the price they paid for the vision and the timeline on which they expected it to pay off. By April 2000, the Nasdaq, heavily weighted toward technology companies, had peaked. Then it fell and kept falling and fell some more. Over 2.5 years, the Nasdaq lost 78% of its value. Not 60%, not 50, 78. Ordinary people who had moved their retirement savings into technology funds on the advice of confident television analysts watched those savings dissolve. Pension funds were gutted. A generation of investors swore off technology stocks for years. Amazon, eventually one of the most valuable companies ever created, saw its stock fall 94% from peak to trough before recovering. 94%. $1 million became $60,000 before eventually becoming $4 million. But you had to survive the journey to 60,000 to get there. The people who made money from the internet revolution were not mostly the people who invested in it in 1999 and 2000. They were the ones who survived the crash and bought what remained at the bottom. Part 4. What Michael Burry is saying. Michael Burry is not a blogger. He is not a social media commentator. He is the investor who, in 2005 and 2006, looked at the housing market, read thousands of mortgage agreements, and concluded that the United States was sitting on one of the most dangerous financial bubbles in modern history. He bet against it. Everyone told him he was wrong. His clients threatened to pull their money. His colleagues questioned his sanity. Then it collapsed. The global financial crisis of 2008 devastated the global economy, and Burry made approximately $750 million for his fund. His story was told in the film The Big Short. In mid-2026, Michael Burry is saying publicly that AI market conditions resemble the final months of the dot-com bubble. Not the early months, not the middle, the final months, the period just before the collapse. He is advising investors to reduce their exposure to technology stocks. When a man with that specific record makes that specific comparison at this specific time, it is worth understanding what he is seeing. What he is seeing is the same thing the data shows. Extraordinary concentration, extraordinary capital expenditure, extraordinary narrative confidence, and returns that have not yet arrived at the scale the investment requires. Part 5. The case that it is different this time. Before we go further, intellectual honesty requires engaging with the other side of this argument. The bulls are not idiots, and the bears are not automatically right. Morgan Stanley analysts have pushed back forcefully against bubble comparisons. Their reasoning deserves to be heard. The median cash flow and capital reserves of today's top 500 US companies are approximately 3 times higher than they were during the dot-com era. These are not speculative paper companies. Nvidia, Microsoft, and Google generate enormous, real, verifiable revenue from products that real businesses pay real money for every month. The dot-com era was full of companies with no revenue and no credible path to profit. Their valuations were built entirely on confidence and hope. Today's leading AI companies are different in a critical respect. They have real balance sheets, real earnings, real products in market. JP Morgan Global Research, one of the most respected financial institutions on earth, puts the probability of a US and global recession in 2026 at 35%. Significant, worth taking seriously, but not a majority view. The same institution models scenarios in which AI infrastructure spending eventually produces a genuine productivity revolution that justifies every dollar spent. And they might be right. The internet did reshape civilization. It did create more value than the dot-com crash destroyed. It was just a long and painful journey to get there. Maybe AI is the same. Part 6. What is actually happening right now? In June 2026, global financial markets experienced one of their sharpest AI-driven sell-offs. The Nasdaq Composite fell 2.2% in a single session. The S&P 500 dropped 1.4%. South Korea's Kospi index plunged 10% in a day, triggering automatic circuit breakers that halted trading. The mechanism was straightforward. Investors looked at the capital expenditure numbers. They looked at the revenue figures. They did the arithmetic, and a wave of quiet repositioning turned into a visible sell-off. This is how bubbles deflate in their early stages, not with a single catastrophic crash, usually, but with a series of corrections, each one followed by a partial recovery, each peak slightly lower than the last, until one day, what looked like volatility reveals itself to have been a long, slow descent. We do not yet know if that is what June 2026 was, but we know it was real, and we know what triggered it. Part 7. What $33 trillion means to you. Oliver Wyman ran the numbers on a scenario in which the AI market collapses proportionally to the dot-com crash. The result, $33 trillion in global market value erased. This is not an abstract number. Every pension fund, every superannuation account, every retirement savings plan in the developed world is invested in global equity markets. A $33 trillion correction does not stay in the portfolios of the ultra-wealthy. It cascades through every institution that manages money for ordinary people. The 2008 financial crisis, triggered by the collapse of the US housing market, saw global stock markets lose approximately 30% of their value in about a year. Millions of people saw their retirement accounts shrink by a third. The scenario Oliver Wyman describes is comparable in scale to that event. This is not inevitable. It is a scenario, a possibility that serious analysts consider worth quantifying, but it is not nothing. Part 8. What to actually do with this information. The honest answer about where this ends is, no one knows. Anyone who tells you with certainty that the AI boom will end in catastrophe is selling pessimism. Anyone who tells you with certainty it will continue indefinitely and all doubts are overblown is selling optimism. Both are selling something. What the data actually supports is this: the concentration is real and historically extreme. When markets become this concentrated in a single theme, the vulnerability to a correction is elevated. This is not a prediction of collapse. It is an observation of fragility. The capital expenditure is running ahead of demonstrated returns. That does not mean the returns will not come. It means they have not arrived yet. The longer the gap between investment and return, the more the narrative must carry the valuation. And narratives are the most fragile thing in financial markets. The historical parallels are worth taking seriously. The dot-com comparison is not precise. The assets are better. The companies are more fundamentally sound. But the emotional structure of the market, the certainty, the concentration, the fear of missing out, rhymes with patterns that have ended badly before. What can a reasonable person do? Understand their exposure. Understand that an S&P 500 index fund today is not the same diversification it represented 10 years ago. Understand that concentration in any theme, no matter how transformative the underlying technology, carries risk. Consider margin of safety. In every financial era, the people who survive and thrive are not always the most aggressive investors in the boom. They are the people who manage downside risk well enough to remain in the game when the correction arrives, and remain curious, because the financial story of AI is still being written. It may end as the internet story ended: painful correction, then genuine transformation. It may end differently. The outcome will be determined by the decisions of millions of investors, regulators, and technology executives over the coming years. The least you can do is understand the moment you are living through. You are living through one of the great financial experiments of the modern era. Watch it clearly. Disclaimer: everything presented in this video is for educational purposes only. The data and analysis referenced come from publicly available reports and financial research. Nothing here is financial advice. Consult a qualified financial professional before making any investment decisions.